G'day folks, welcome back to another update for high grade copper and US crude. Now they've both broken down strongly like most other things in the market these days. So we're also going to include some back testing and show how to trade those in a short positioning. Before you go any further, make sure you hit that like and subscribe button to support the channel. But also don't forget, we're also including a new video series. It's called Pete's Investing Plus One, and that's where we go through some very basic 101 trading strategies and instructions for those new to trading and help you get started if you're very new to trading and try to understand the analytics. Hopefully this series will get you started. The latest one we did was setting up a chart and the way we read those charts, and that's attached in the description below if you want to reference that for any newbies out there. In terms of the outlook for high-grade copper and US crude prices have declined to 4-year lows due to OPEC's unexpected output increase and escalating global trade tensions. Analysts forecast continued volatility amid geopolitical uncertainties and shifting production levels. For high-grade copper, prices have surged to record highs driven by US import tariffs and increased demand from the clean energy sector. However, Chile's anticipated price reduction reflects concerns over a potential global economic slowdown. So first looking at US crude on the long-term trends, you can see on the monthly, the price has been below the moving average for some time now, since most of 2024. It started back in 2023, made a bit of a break above that moving average, then it broke below and has been hovering below that since. The CCI likewise has been roller coasting up and down, but more recently it's been bearish, so very bearish at the moment on US crude on the monthly. On the weekly likewise, and there's no bearish or bullish divergence at the moment on the monthly and the weekly. On the daily, if I zoom in, it hit this resistance up here at 79.60, broke down, bounced off this minor support at 65.04. And we had a bit of a nice little bull run there, but again, we don't go in when you're trading these, we don't go against the bigger time frame. So if you're trading on the daily, you only trade in the direction of the weekly and so on. So the daily at the moment is broken below that, and we're bearish on the daily as well. Now if we go to the intraday chart, we look at the 1 hour chart. In our last update, we did have this bearish divergence, and the price actually broke down and hit this target area. And since then, the price then bounced out of there. And these are the minimum target areas, by the way. So it bounced out of there and it went higher. And then we started seeing this new bearish divergence, lower highs on the CCI versus higher highs on the price. Now, if I was to draw a target range for that, I would have taken the Fibonacci back to that area there as a minimum. So you take it back to the significant low, or even that area there possibly. That might have been a better spot to put the Fibonacci. And you can see there it broke very easily through that 23-38% range. But you can see there it's actually broken below the 100% retrace level and gone down as far as 161% Fibonacci retrace. And at the moment it's bouncing up from there, approaching the moving averages of the price. The CCI has already broken through the moving average. There was a small bullish divergence, you can see there. And if you saw that during those few hours of trading and you're going short, that would have been a good place to get out of your trade in one of those candles down there. But at the very latest, you should have got out when the CCI broke into that moving average range on that green candle. That would have been your exit. So let's go to the back test. So this is, let me just get rid of this Fibonacci very quickly. So this is the back test, and what we've done here is we've started it from this candle here. Now that's above the CCI, but again, if you're reading this with the bearish divergence, you would have been noticing. That's why even if you're trading on the daily, that's why we look at the 1 hour as well, because the 1 hour gives you a micro view of potentially what can happen and how it can actually change course. So if you're looking at that, seeing the price pretty much go sideways, but the CCI lowering or going a downtrend a lot stronger, that was a starting point. Even up to there, that was a starting point of a bearish divergence at those little peaks there. Higher highs and lower highs. The price kept going sideways pretty much, made new highs, but the CCI made lower highs there. And had you got in around that area there at the very latest in one of these candles, probably on that one, that would have been an ideal spot to go in short. And by that stage, it's already broken. And as you can see what's happened on the daily, it had some very massive falls. And that would have given you some nice little returns. So again, from there to there, let's say we got out of that one, that would have been a 13% return on that trade there. So for high-grade copper, again on the long-term trends, you can see there we've got still bullish movement on the price chart, but you notice something here in our last month's update. We had this double top on the CCI versus higher highs on the price. That's a bearish divergence on the monthly. Actually, that might be slightly high, but I'll still consider that a bearish divergence, and that's actually pulling back the current month from that high we reached previously. On the weekly, there's no divergence at the moment, both long or short. But it's still actually broken into that moving average range on the weekly, and the CCI likewise broken into that moving average range. So avoid going long, obviously, and more favour towards the bearish side. On the daily, it's hit this resistance at 53.953, and there was no divergence there that I could see, but that's actually broken through below that moving average range on the price, and by that stage the CCI was already well below. Try and avoid going into the trade, even though the CCI shows a bearish movement back here. You've got to be careful because the price actually could have bounced off that moving average range. So you want to ideally wait for this to break below the moving average range of the price chart as well as the CCI. So at the moment, bearish movement on the daily. If we go to the 1 hour chart, again taking short trades only, again you could have taken some short positioning back here or even back here, to be honest, and that would have been a break even or a small loss had you got into those ones. And then more recently you could have got in up in that one. That would have been a bit of a break even, and then finally broken down on that one there, and that's where you would have been ideally getting into the trade, and that one would have given you a nice little return. Now this one actually closed out a few times if you're following the CCI down here when it touches the moving average range, so you could have got out with those little losses or small gains. But again, get back in a trade when the CCI breaks to the downside. The price is already below the moving average, so that would have been another entry point at that point. You got out there, small little gain, and then another entry that way, and another small gain on that one, and then lastly on that candle, and you would have got out. Now you'll notice down here we've got a bullish divergence, higher lows, albeit very narrow or close together. Sometimes these reap a lot more stronger retraces to the upside. So you can see there are higher lows on the CCI, lower lows on the price. So ideally, as soon as you see that higher low down there, you would have got in right at the bottom there. Now this could drop further, of course, but you don't want to go against the CCI. The CCI is currently rising. Of course it could drop, but just to be extra safe, get out of the trade at this point and wait for it to break below that moving average to enter again like it did back here. Now if we go to the back testing, so similar to US crude, we get in at the top here when the candle breaks below the moving average range and the CCI is already below. That's around this area, and you can see here the stop loss approach has generated 3,285, and the average down has generated 6,846 for a high grade copper contract, and you would have averaged down a few times there, hence the higher profitability. Again, just got to be very careful when you do average down. You've got to make sure you've got enough funds in your account to allow for any drawdown. So again, don't forget, we've got a new series coming out almost on a weekly basis. So we're going to include it with some newbie questions from special guests, and that's going to be called Pete's Investing Plus One. And the last video we did, or the first video we did on the Plus One series, was setting up the chart on any of your charting software packages. Thanks for watching. Hit that like and subscribe button, and see you in the next week's update.